Ladies and gentlemen, welcome back to the channel. Here in this video, we will discuss the year-end rally that now has a lot of people second guessing, I guess rightfully so. If you look at something like the RSP, for an example, the thing's been dying recently. I mean, this is the most red candles consecutively I've seen in a very long time. You're sitting at a very critical level, which is your 50-day moving average. And overall, things do not look good. You've had more stocks declining than rising every day for 10 days now. That's not a great sign historically, and that has not happened since 2001. So here in this video, I will explain how and why we could get a year-end rally, but why we are set up for a correction in Q1. Isn't it funny how things work? I usually tell you guys something long before anyone else talks about it. In fact, now, take a look at this. 314's Warren Pies says he expects to see a growth scare in late Q1. Take a listen to this.
Our next guest sees about a 12% increase in the S&P 500 by this time next year, but warns it won't be smooth sailing to get there. Joining me now is Warren Pies, co-founder and strategist at 314 Research. Warren, happy Friday. So a little interesting exchange between our Jim Cramer and President-elect Trump just a couple days ago. Take a listen to this.
When President Reagan was here, he talked about putting the bear into hibernation, letting the bull run free. Yeah. Sound like a good motto?
Sounds perfect. I can't do any better than that. That's what we're going to do.
Okay, 2025, Warren, the market's going to be in a far different place than 40 years ago, 1985, when Reagan said that. The market basically ran for a couple of years after that statement of his into Black Monday. So is Trump's version of Reaganomics, you think, going to work on stocks here?
Yeah, thank you for having me. And I do. I think it's going to work. Obviously, there's major differences between the two eras, but the general feeling of having a president in the White House who is keeping tabs on the stock market and would go down and ring the bell. I mean, I do think it's going to work. That was the title of our research report, was that letting the bull run free, our 2025 outlook. And so, yeah, I don't think it's going to be necessarily because of Trump, but it's good to have an administration that's not going to get in the stock market's way at the very least.
So why do you think stocks stumble in the first half of 25?
Yeah, I mean, we still think that the soft landing is intact. That was our call last year. And I would say, when you zoom out from a big macro perspective, there's always, I'd say, two big risks: inflation or growth. And last year we were more worried about inflation not coming down fast enough to allow for the Fed to cut. Whereas next year, I think that the bigger risk is growth. I think that we're going to have another growth scare. It's going to emanate from the housing market. That's going to probably be in, it's really difficult to pinpoint, but late Q1, early Q2. And that's going to put the spotlight back on the Fed. I think there are a lot of people like your last guest who are worried about inflation and thinking the Fed's about done with cuts. And I think the Fed's going to have to cut more. And there's going to be a little bit of pain in that process. But ultimately, I think the Fed will cut more than the consensus expects. And the soft landing continues, and we end up with a double-digit gain next year. Okay,
so you didn't think that inflation would come down enough for the Fed to cut. Some would argue that it didn't, and they cut anyway. What's going to change?
Yeah, well, I think number one, on the inflation side, the three big vectors of inflation that have infected the economy are all fading. So shelter disinflation, something we've watched for a long time, is going to roll over hard by our calculation early next year. So that's been the big holdup for CPI, something the Fed's been waiting for. So that's going to happen. A lot of people look at the 1970s and see a second wave of inflation, and that required a massive disruption to the oil market. We had 4 million barrels a day go offline into the second wave of the 1970s. This time around, we have OPEC adding back over 2 million barrels over the course of 18 months. So totally different oil market. I don't see any pressure from oil. And then finally, labor market's weakening. Less than 60% of total industries are growing payrolls at this point in the cycle. And that's honestly a recessionary level. And when you look down at the leading industries, we look at the housing market, for instance, and residential construction payrolls, everything we see is looking like the labor market is weakening. So I don't think there's going to be any inflation from those three areas.
If you're wrong about 2025 being up 12%, what's the factor you think that's going to hinge on?
I think it's going to be so the Fed is trying to rehawk right now a little bit. I think they're trying to pause and trying to, say, let's see what happened with these last few cuts. Again, I think that the growth scare is going to hit very similar to what we saw coming in the summer of last year, where the Fed chose not to cut in July and then had to do 50 basis points in September to kind of support the market. The big risk is the Fed sits on its hands too long, and that maybe they, for some reason, whether it's political pressure or inflation or whatever in the data, and they sit too long and don't cut aggressively enough to bring down longer term rates like mortgage rates. We think you need to see mortgage rates get back down to like 6%. And that's going to take probably 100 basis points of Fed cuts next year to do that. I still think it's going to happen, but it's going to take some aggressive action from the Fed to keep the soft landing going.
And honestly, I mean, I agree, right? I used to say, before the election that we weren't going to get any bad data before the election. Like the economy was going to look fine. Things were going to be just okay. Well, now that the election's over, it seems like we're starting to get some bad data. We're starting to get bad CPI reports and bad PPI reports, and initial jobless claims for 2 weeks now have been going higher. It just seems like the data is starting to get worse now. Well, this week is going to be so important because we get a lot of data, and we're going to have a pretty good understanding of, well, how is the economy doing by the end of next week? And okay, here's the deal. Between now and year end, as long as nothing is really bad, the markets are not going to all of a sudden turn negative on 2025. Okay, people are kind of in holiday mode. People are in this, oh, it doesn't matter, it's the end of 2024 mode. Like, I can't see anything that's going to really derail the bull thesis for next year, given everyone is so bullish, just between now and January 1st. So what this means is, as you get these catalysts out of the way, it frees up opportunity to be bullish for markets to move higher. We have our big catalyst, which is the Fed on Wednesday. The Fed's going to be important because the Fed's going to really confirm, are they as dovish or hawkish as we think they are? Markets are pricing in pretty much a certainty that the Fed is going to be cutting rates next Wednesday. But is the Fed hawkish now? Have the latest CPI and PPI reports turn the Fed into a bit of a hawk? That's what we want to know. Now, honestly, markets are expecting 3 cuts next year penciled in from the Fed. That's probably what we're going to get. Like, are we going to get a big negative surprise there? Probably not. Could we get a positive surprise? Probably, but I don't think the Fed wants to give us that, given the hotter than expected CPI and PPI reports. But what it will do is meeting expectations will free up a risk catalyst, and that could allow markets to rally into year end. But again, remember, as I've said for weeks now, maybe a month or so now here on the channel, we are set up for a correction in Q1 2025. The reason for this is actually very simple. We've priced in the good from a Trump presidency, at least partly. Deregulation, a friendlier regime to the stock market, right? They actually like the stock market. Trump just rang the opening bell, okay? These are all great signs. Wall Street is also expecting a strong economy. They are expecting inflation will slowly come down next year. Not anything really, impressive, but slowly, continuously come down. We expect the Fed's going to be cutting rates 3 times next year. That's about as optimistic as things are going to get, okay? The issue will be is when, let's say between now and the start of 2025, initial jobless claims keep going up. Well, that's not good. What if retail sales next week comes in bad, or personal spending comes in bad? That's a problem. Now, again, is it going to derail the bull thesis into year end? Probably not. But what happens when these data points come in bad in January? Then you bring up a growth scare. Then you get Wall Street that says, oh crap, valuations are too high because the economy is not going to be as good as we think. I say quite frequently here on this channel that valuations don't matter until something changes, okay? In a constant environment, valuations do not matter. Nobody wakes up one day and says, Apple, yeah, that's too expensive, trading at 28 times next year's expected earnings, and sell the stock, right? Nobody wakes up and sells Apple because one day they woke up and they think it's too expensive, okay? But if the economy starts to look like it's not going to be as good, then 28 times next year's earnings all of a sudden looks a lot worse. And that's when valuations matter. So the whole time we've seen valuations continue to go up and up and up. It's been just fine because the narrative really hasn't changed. But there will be a growth scare, as Warren Pies also says here, and that is going to cause a correction. Probably a pretty severe correction in my personal opinion. Again, between now and the start of 2025, are you really going to see data that's going to be so bad it causes everyone to freak out? I mean, it's possible, but probably not. Okay, that's my bottom line assumption. On Monday, you have composite PMIs, manufacturing PMIs, and services PMIs. That's it. On Tuesday, you have retail sales month over month. That is a very important data point. We are expecting high numbers, 0.5% month over month. If this were to be like negative 2% or something, yeah, that may change the narrative a bit. Is that going to happen though? I'm not convinced of that. Wednesday, we're going to get building permits and the Fed. We also get a summary of economic projections. That's basically how many cuts does the Fed expect next year? What does the Fed expect inflation to do next year? What does the Fed think GDP is going to be next year, right? All of your projections coming out Wednesday. On Thursday, you will get GDP growth rate quarter over quarter, final estimates for Q3, Kansas Fed data, Philly Fed data, and some other regional data. And then on Friday, you get core PCE month over month, expecting pretty much in line numbers with last month is 0.3%. Personal income month over month expected at 0.4%. And personal spending month over month expected at 0.5%. So again, we do have big data this week, but I don't think it's going to cause the markets to freak out. I do think it'll probably come in on the lower side, which could cause 10-year treasury yields to come down a bit, which could actually be positive for small caps and maybe, interest rate sensitive companies like a Tesla, for an example, potentially could do well next week. I will also say that despite what the headline market has done, you've seen the RSP decline a lot. You've seen the equal weight S&P come down quite a bit in the last 2 weeks. Again, for 10 days in a row, you've had more stocks falling every day than rising. I mean, that's not good. But it's almost like you're starting to get so relatively negative that maybe there's room for an upside surprise. CNN's Fear and Greed Index is neutral at 50. Like, you're definitely not euphoric like some people thought we were. Percent of stocks trading above their 50-day moving average on Friday was down about 3.5%, down to about 54%. You're definitely not euphoric there either. So there is a fair bit of room for markets to get more optimistic. Sentiment is just not that stretched anymore. And from that perspective, that could lead markets higher. Bullish investors fell from 48.3% down to 43.3%. Pretty large fall on a 1 week basis. Neutral investors rose from 21.0% to 25.0%, and bearish investors also rose from 30.7% to 31.7%. So again, not that optimistic. Now, again, in the case of Tesla, I mean, I don't think there's anything that can really stop Tesla between now and year end. It would take some kind of disaster to really stop Tesla at this point. It would take like some Tesla specific bad news. It would take something really bad happening to derail the momentum that we're seeing in Tesla. We're currently experiencing a gamma squeeze. I think we could start to experience a short squeeze into year end. And even if markets are red, like again, you've seen on Friday, that doesn't mean that Tesla has to be red either. Tesla actually accelerated to the upside as the markets fell. Okay, so as the markets fell throughout the trading day on Friday, Tesla closed up 4.34% on very little news. Yes, there was news over in Europe. Switzerland is preparing to ease some restrictions on full self-driving capabilities to potentially allow robotaxis to launch into the country. That was good news, but I mean, Tesla kind of ramped higher throughout the day. Like that was not the main news that caused Tesla to go up 4%. That's just what is kind of what evolved in Tesla throughout the trading day on Friday. So from that perspective, I mean, I think Tesla's going higher into year end. I think a short squeeze mixed with a continuous gamma squeeze that I'm expecting could push Tesla easily over $500 per share. And with the opportunities ahead of Tesla with Robotaxi and Optimus and, more mega packs coming online next year and the semi-factory and lower priced Teslas, right? So on and so forth. I think it's really hard to try to limit Tesla here. Like, I mean, if Tesla executes well, buying Tesla at these prices could be cheap. I mean, that's the hard part. You don't really know, but I think things look pretty damn good for Tesla from that perspective. I will also point out that volume, Tesla's kind of been rallying on low-ish volume. I think you're probably due before this is all said and done with, for 120, 150, 200 million plus shares trading hands. Today, you had 89 million shares that traded hands. Like, sure, is that okay? Is that good? Yeah, but it's like, it's not high, okay? So usually you don't get rallies that end with low volume. Usually you get that volume spike, you get a bit of, upside capitulation from the short sellers, and then you get that streak of downside. Then you get the rally that ends. At this point, you're just not there yet, in my personal opinion. So let me know what you guys think about all of this information down below in the comments section. Have a fantastic rest of your day, and I will see you in the next one.